Welcome back to Switzer on Australia's Business Channel. As stock markets are tending towards the positive, if a curveball is going to come, it could come from three origins: China, Europe, and Japan. So we go to our big batter from Brisbane, Marcel Von Pfyffer from Arminius Capital, to see if he can hit this curveball concern right out of the park. How are you, Marcel?
I'm very good, Peter. How are you this evening?
Mate, do you feel comfortable with this baseball analogy?
I like it. I preferred the one about doing the reconnaissance in the previous interview, Peter. That sort of recon is more my style.
I know all you young people. I don't think you young people can spell reconnaissance, and that's why you have to recon. But let me not be discriminatory.
You're very ageist tonight, Peter.
I am. Let's just stick to the main game. I'm getting a feeling. Maybe just before we start. Are you feeling as though we're tending towards the positive on the market at the moment? And if so, and if not, well, let's answer that first question first. Do you think we're heading towards the positive?
Yeah, look, there are a lot of mirages around at the moment, I think, Peter, and I'm not talking about French NATO fighter jets over the Crimea. I think that the fundamentals are actually kind of okay at the moment, as you are alluding to. The potential speed bumps for the remainder of calendar 2014 are really going to come from exogenous shocks or major global macro shocks. For our concern, Australia, really just from China. I don't think we'll dig into the European situation and Japan a little bit later as well. But I think really our tied brethren, our export partner, China, is the person that we have main concern about. I don't mean concern in a negative way. I just mean that we track their movements the most. And again, the People's Bank of China and the National People's Congress, I don't think there's a significant headwinds for this calendar year to derail our train in Australia too much by December 2014, no.
Okay, so therefore China you're feeling comfortable with, and some of my experts in the program have said there might be problems 2015, 2016, but this year they feel reasonably comfortable. Can we get an agreement on that and move on to the next subject? Yeah, look, their debt to GDP ratio is 200%, Peter, which is not exactly what you'd call healthy. And again, as Deng Xiaoping said, to shop is glorious, but the credit card bill is going to be paid somewhere, and it's being paid by debt at the moment. So, yeah, there is an event coming, Peter. We don't know how long it'll be, but I think that the next 12 months, I think, should be clear sailing from China. Yeah. Okay, let's move to Japan next. We'll finish with Europe. What's your view on Japan?
Yeah, Japan is in all sorts of trouble and continues to be so. Look, their inflation rate at the moment is about half of where they'd like it to be, in the 1%. Its GDP also is in the 1%. Last night, the Abe government brought down the first increase in the sales tax in their version of the GST, raised it by 3%. The last time that this happened in 1997, the Tankan survey, which the viewers may or may not be familiar with, the Bank of Japan puts this out, and it's a bit of a confidence type survey, if you like, of economic conditions in Japan. The most recent one that came out this week is actually twice as negative as the one that came out in 1997 after sales tax went up, as I said, by 3% this week. So the feeling in Japan, again, their colossal gross government debt to GDP levels are again combating China's at about 220%. But again, Mr. and Mrs. Watanabe, the Japanese domestic person, is the main recipient or the main investor who purchases Japanese government bonds. So their problems are not quite the same from a debt perspective as the rest of the world's are. But again, their economy, Peter, it's sort of 2 steps forward, 1 step back. And the third arrow of Abenomics, this increase in the sales tax, we will have to wait at least 6 months to see the effects that'll filter back through their economy.
Now we know that they started this monetary expansion a lot later than the US. And when the US started with their monetary expansion, they started at QE1, went to QE2, QE3. It took a while for it to actually bite and improve the US economy. Could Japan be in that kind of, and you know yourself, monetary policy always takes a long time to actually work?
That's exactly right. In the academic world, we'd say 18 months.
Yeah.
So it will be some time yet before things take off. And again, there are major, significant structural issues present in the Japanese economy that, again, even if this increase in the sales tax does work, and I think getting people to run out and buy packets of cigarettes and toothpaste 2 days ago, that only has a certain effect in an economy. And as we remember here in Australia, just going back to being ageist, Peter, when the GST was introduced, people actually expected that there would be significant impacts upon consumer spending patterns. And what we learnt 12 months forward down the track is that consumption patterns hardly changed at all, despite the fact that there was a 10% sales tax on everything. Yeah,
it's funny, you do need toothpaste when you're a big smoker, mate, that's for sure. Let's go to Europe now. And some of the data coming out of Europe is surprising a lot of people. It kind of looks better than what we would have expected. But you're my European man with a name like Von Pfyffer. What's really going on there?
Jawohl. Look, the inflation numbers for for Europe also came out for the Eurozone this week, 0.5% for the most recent year-on-year change. So Europe is growing at 0.5% per annum. Sorry, not growing. The inflation is 0.5% per annum, which actually makes the Japanese look like speed freaks at 1%. So the European recovery continues. The problem is that unemployment remains at 12%, right? It's at 11.9%. Unemployment in Italy is 13%, in Germany 6.7%. But again, the problem here is consumers. Okay, we all come back to it. Doesn't matter if it's Australia, the US, as Dr. Yellen is embarking upon. A lot of her comments as the new head of the Fed revolve around the labour market. So everything, Peter, comes back to the jobless rate or the unemployment rate, and how much do consumers spend to actually create inflation in an economy, which increases growth in the economy. So, yeah, GDP very, very slowly continuing to recover, of course, in Europe from the doldrums. But again, these guys have got a problem because monetary policy at the moment under Mario Draghi is 0.25%, so they can't cut much further. As we said, I think it was 4 weeks ago, Peter, on this program, is that Draghi is looking to revitalise the credit markets, which is French or Greek, for saying that he is definitely thinking about QE. Yeah. And after that, then they go to negative interest rates, right? So again, inflation, or rather the lack thereof, is becoming a problem. It's not so much growth. Growth is ticking along in a lot of these countries, but the problem is actually deflation, dare I say it, or a distinct lack of inflation in all of these economies.
Okay, so just in a nutshell, before we finish, how are you and your business playing what you're seeing in front of you? I know Michael Knox said he happily invests with you. So what are you doing to make money in this questionable market?
Go back to what we just talked about. Yellen's perspective, Mario Draghi's perspective, they're very concerned about the labour market. They're very concerned about unemployment. So they are putting the megaphone to their mouths. They are going to keep interest rates very low for a long period of time. The direct beneficiary of the relationship between low interest rates is that money flocks to the stock market, Peter. Yeah. So again, if you're buying US equities, if you're buying Australian equities, we might leave Glenn Stevens' most recent comments in Hong Kong last week to the side for a moment, but in the US, in the European theatre, all of the signals are pointing, because of their problems, is that QE and low interest rates are not going away anytime soon. The pace may slow, but they're not going away. So people, quite frankly, are going to buy stocks for both capital appreciation and also, of course, that D word, dividends, Peter.
Yeah, fantastic, mate. Thanks for joining us on the program.
Take care. Thanks, Peter.
So the hype around the housing bubble is getting bigger by the week, but it's generally being pumped up by my colleagues in the media. So what are the real experts thinking about the house prices right now? John Edwards, the founder of Residex, is a ridgy-dig real estate expert. John joins me on the show. How are you, mate?
Very good.
Now, do you get the same feeling I do when you open up the paper on Saturday and there it is, a housing bubble story there? Do you say, oh, not again?
And I wonder why they do it. because at the end of the day, their revenue is largely driven by advertising from real estate.
That's true. That's true. They're cooking a golden goose.
Yes.
All right. So, John, I guess what I want from you is, what's your feeling around this housing bubble story?
Well, I don't really think there is one. I think that, well, I would have been a little happier if the Sydney house prices hadn't have grown as much as they have in the last 12 months. Yeah. And we could probably put a graph up there while we're talking so people can see what the market's done in the last 12 months. Yeah. But I would have been happy if we hadn't have got to about 15.1 or 15 point something in the last 12 months.
So it's a big boom.
Well, no, that's not a boom.
Isn't it?
No, we go back a couple of decades, and we called a boom 30, 40, and even 50%. I mean, we saw 50% growth in 1950. You know,
we weren't talking bubbles there.
We weren't. Okay. And there's a natural limitation on how high a housing market can go. And when I look at the stats, I mean, the Sydney market leads all the other markets. It's the leader. And so we should watch what it's doing to understand what the others are going to do. They lag behind it. The Sydney market, when I look at the data, looks to me as if it's starting to actually turn over. It's looking as if it's starting to get a bit softer.
Yeah, John McGrath said the same thing.
Yeah, I look at the auction clearance rates. Everything that I look at tells me that we have actually peaked and we're now on the downhill run. So I think it's fairly safe. I will look very...
Is this the chart you want to see, or was there actually a graph?
Yeah, well, I mean, I think it's helpful for people while we're talking to look at it because there's a lot of data there.
Yeah.
But you can see that there's
the Sydney at 15.19.
Yeah. And there's a little bit of red starting to appear. You can see in the last month in some of the housing.
Well, what's really interesting is I think the bottom line of these stories we're reading in the newspaper saying, maybe the Reserve Bank's going to have to prick this bubble, but it's really only Sydney. Melbourne's 10.8, but all the other capital cities, they'd be, Perth's 9.25, but it's coming down, I suspect, rather than going up, isn't it, Perth?
Well, yeah, and it's turned over too, yes.
Yeah.
So the market looks to me like as if, yes, Melbourne and Sydney are going to start to turn over and start to slow down shortly. They're going to have some growth. All of the rest of the markets, however, running into the third quarter of this year, will probably start to rise and show growth a little bit bigger than we've seen in the last quarter.
Yeah.
After that, they'll start to slow too. By the time we get to next year, my anticipation is that, in fact, the housing market will actually be doing very little, probably underperforming inflation. But for a couple of years it will do that, and then it'll pick up about 2018 again, and it'll start to move forward. Now, the reason is that the Reserve Bank, by the time we get into the middle of next year, will be starting to move interest rates up. But I think you can expect a lot of jawboning from the Reserve Bank just to try and get this market to turn over like it's doing and continue to turn down a little bit, because they really don't want house prices. I mean, Stephen's made it so obvious so many times that he is uncomfortable about Australian housing prices. He cannot see how we should have the land that we've got and yet have housing at the high cost that it is at.
Yeah. Now, also you've got the apartment or the unit prices here. Is there anything distinctive about that?
Well, there is something that's really interesting about that. If you compare the Sydney and the Melbourne growth rates, compare the Sydney and Melbourne house price rates to one another at the same time, what you see is the differential between the Sydney house price and unit growth rate is only a couple of percent, but in Melbourne it's more 4 or 5%. And so what's going on there is the supply issue, and that's the real risk for Melbourne. It's the oversupply of units, and while everybody's really keen to see housing actually increase in the volume, yeah, it does, but we also need to be careful, because when I look at the stock numbers, I can see that we're getting close to being balanced or oversupplied in many capital cities. And so we need to be careful about it. Australia is a country that is growing on immigration. And so if we need anything, what we need is the delivery of more, and people won't like it very much, but we need more migrants, and we need to boost our economy, and we need a housing market that with supply being provided, so that we've got jobs, but we've also got growth. And I mean, when you think about a $60 billion deficit, or that's being talked about for some considerable time, we need a housing market to really move forward.
Okay. And we'll come back to the apartment story in a minute. We've got the regional story up there at the moment, John. And what's the big takeout lesson from this?
Well, what it really shows you is that the regional markets are doing sort of moderately well. I mean, that also points to the fact that this housing market isn't going to get into a bubble formation because we would have very strong growth in those regional markets if, in fact, we were going to move into that. Because what you get is investors looking for higher rental returns, and you get higher rental returns, as you'll see in a minute when we look at the rentals, coming out of your regional markets. They get a more steady rate of growth. You don't get the same cyclical effect, but they usually grow much less.
And I guess the WA country is the effect of the mining boom coming off the oil.
Exactly, that's what we're seeing.
And how come New South Wales country is staying up? Is it because New South Wales country has a number of industries from not just mining, they've got agriculture as well?
That's right. The economy in New South Wales is, in many respects, very much like Queensland. It's got a very diversified economy, and so it doesn't hurt as much. I mean, the Sydney market, yes, it's very much finance, but regional New South Wales, we've got gas, we've got mining, we've got the largest gold mine in Australia in New South Wales.
Yep. Now, here's the unit price as well, and they all seem to be doing pretty well right around the country. And I know on my 2GB program, someone asked me last night about Dubbo. Is Dubbo, in your recollection, a good country regional town?
It has been recently. When you get out into that area and you start to get out into the lifestyle areas as well, and I mean, you get into the vineyard sort of areas and those sorts of areas, those areas have done reasonably well. And the other thing is that our weather, or whatever it is, our farming community, if I could say that, has been doing a little better. There are droughts around, but nevertheless, our rural population is actually faring a little better than what it did 5 or 6 years ago.
Okay, now we've got the 5-year predicted growth forecast.
Well, you can see there's nothing enormously spectacular in
There's no bubble in
any of that. And what's happening is that these are statistical models, and what they're telling us is that at the end of the day, the affordability is actually holding our market growth rates down.
Explain that
well, you can't. Okay, if you've got the median value of a house in Sydney, that's the median value of all houses in Sydney, not the median sale price. The value is about $786,000.
Yeah.
All right. Now let's just convert that to $100, and let's say that we grew at 5% per annum every year. Well, let's say that it grew. It was $100,000 last year, and it's $200,000 this year, and it grew at 10%. You got $10,000 increase 1 year, but now you've got $20,000. Now, if wages aren't growing at the same rate, it must slow. And what people and analysts
and wages are not growing fast.
That's exactly right. And what people forget, they keep on looking in history and saying, well, the housing market grew at 7%, 10% or whatever it was, therefore it's going to do it in this cycle. No, it's not. There is this natural limitation of affordability which will actually hold it in place and actually stop the bubbles from occurring in situations like this. They only occur if your bankers overlend and become very aggressive and take too high levels of risk. So APRA and the Reserve Bank can stop this process of there being a bubble, which I don't think it's going to be anyway, by just simply controlling our lending.
Okay, and here's your country forecast as well. There's nothing all that significant there, I guess.
Except they're not real, many of them, are they? They're below inflation.
Yeah, that's true. Very, very true. Yeah, so if people were looking at this, where do you think are going to be the best places, like the best states or the best cities for growth going forward?
Well, I think in a situation like this, what you really want is the diversified economies. And I think that one of the next slides that's going up there,
the best
growth suburbs that occurred. And you can see these were at the top end of the market. Now, I'm going to be looking very carefully at that this quarter to make sure that that's where it's occurring. Because if all of the growth is occurring at the top of the market, that's a pointer usually that the cycle of growth has got a little bit further to go.
Right.
But we're 3 months in, and you can see that the predominance of all of those places are their high-end costs. So that would tell me that we're probably past the top of the market. We're now starting to come down to the bottom. If we can look at the actual rents or the units, I think we're probably going next to.
Yeah, I'd say so.
There are your unit suburbs, and again, you see how it's sitting at the top end of the market. So that's
when you say the top end of the market, what do you mean?
Cost.
Top cost. So they're not cheap.
No, they're not cheap properties. No.
Okay.
In every one of those places, they are basically expensive places for where we are. We look at the rental, and these are the top performing now.
And these are very important for people who want to buy investment properties.
Yes. Now look at some of those rental increases, 38.78% that's occurred in Queensland. and Greenbank 16.
So Queensland is starting to move. A lot of people have predicted it, but the house prices aren't showing, but the rentals are.
And that's pointed to the fact that you asked me where I was going to go, and that's where I would be.
Yeah.
The diversified economy, Queensland and New South Wales are the two places that we ought to really be looking at carefully, and those rental increases are a really good pointer to that now.
All right, but is it too late then to look at places like Yarrabilba and Greenbank, or is it because they've got nice rent rises? I guess you're going to find your yields will be pretty good if you can buy.
Exactly.
If you get a good price.
And once the rentals start to rise like that, the capital growth will move forward a little bit. If you've got those sorts of rental returns, you're going to get reasonably good capital growth because the investor will come and follow that. Okay,
so they're nearly all. They're nearly all Queensland.
That's right.
Yeah.
That's right.
Cranebrook houses, is that in New South Wales, is it?
Yes.
2749,
yes.
Yeah, okay. And Mount Annan houses as well, okay.
There you go, and Greenfields in West Australia.
Okay, great.
All right, so if we can have a look at the, what have we got next? We've got the bent. Now, these are the suburbs that have actually got the best predicted 5-year rates of growth, and you can see that there are areas which do pretty well. We've got a 10% there and a 5% there, and rental yields, you can see they're holding around about 5% or thereabouts. That's about where it is across Australia, where there's any good return. I mean, if you look at it and say, well, I'm going to get about 16% out of Morayfield in Queensland in total return, that's not bad.
No. And what's interesting is that when people think Queensland, they think apartments in Brisbane along the river, but they shouldn't. They shouldn't. Now, tell us why, John.
Well, when you go to...
They were a good buy once.
Once, yes. Yeah. But at the end of the day, when you go to sell something, you want to be selling something that's unique and everybody else... nobody else is selling it.
Yep.
You want to be the only one selling it, and you want to be special. So everybody comes along and bids for that special particular place. But all along the river, the Brisbane River's not too much different from one end to the other, is it?
Maybe harsh. We've got a lot of Queensland followers here.
I'm a Queenslander, right?
But there has been a lot of oversupply there.
Absolutely. And so what I'm really saying there is that at the end of the day, there will be too much competition when you go to sell and when you go to rent, and that's not what you want when you invest.
Exactly. John, thanks for joining us on the program.
Pleasure.
And I'm glad to see that you're saying no housing bubble. Thanks, mate. After the break, Australia can add another exploit to our list of national achievements. We're the world best givers. Just how generous are we? We'll find out coming up.